Hi, this is Andy Filipiuk in Toronto for the week of July the 19th. Well, this week we've seen tremendous volatility in the markets. Monday was a huge sell-off in which we saw the Canadian dollar also drop over a cent. And the last couple of days we've seen a bit of a recovery. But one thing that continues to amaze me is the US 10-year Treasury. It got down to a yield of 1.13%. And this isn't despite the fact that the headline inflation right now in the States is 5.4%, which is just, to me, crazy. Well, there was a very interesting interview of Leon Cooperman, a billionaire hedge fund manager, the other day on CNBC, and he had the same problem. He claimed he didn't understand the bond market. Normally, the 10-year U.S. Treasury trades at roughly the nominal GDP rate, meaning the real growth rate of the economy plus inflation. So with inflation at 5.4% headline and an economy that's recovering, the 10-year should be way, way higher than the 1.13% I just quoted. But one of the points that he mentioned that I found very interesting is his claim is that pension funds can buy U.S. Treasuries and not have to market them, meaning they can buy the bonds and they don't have to worry about the fluctuating price. As long as they hold to maturity, they don't have to put the actual market value on that. And we saw that in the 2008-2009 crisis with mortgages. The regulators moved so that the banks could continue to hold mortgages that were down tremendously in price and hold them at a par value, just as long as they continued to hold them till maturity. Now, this is an example of the regulators really trying to accommodate the huge, huge deficits that the U.S. government is running. Nobody in their right mind, in my opinion, would be buying U.S. bonds with such a low yield and a high inflation rate unless there was some sort of way to not be punished. So here we see another example rather, of adjusting the rules to help accommodate the government with their huge spending and keep the market going. Thanks for watching.